All right, welcome to another episode of the Mortgage Show, joined by a special guest today, Darcy Bastarache. Thanks for joining me in beds today.
Thanks for having me.
It's a lovely day in Maine today, snow day. Kids are home, kids are upstairs. Looks like I just rolled out of bed. How you guys doing?
Well, the snow blowers just started up outside my office, so if you hear a loud rumbling, that's what it is. So,
Oh, don't even hear it. It's not even that bad out.
no, not at all. It was easy driving, a little bit of sleet, and it's going to end. So,
Good. Bets, how you doing this morning?
You were just commenting. I actually feel like I always look like I rolled out of bed.
That's just your look.
Yes, I'm doing good this morning, man. Thanks for asking. Looking forward to ripping through another pod.
Yeah, absolutely. Me and you've been doing a lot of pods lately, Darcy. I don't know if you saw me in bed started a sports podcast last week called The Cheap Seats.
I'm loving it.
Did our first episode. If anyone listened to our betting advice, they would have heard us say take the Eagles and the over. Both hit, no big deal. Beds called how the game was going to go in terms of the line of scrimmage. Do you want to comment on that, Beds? I posted the reel yesterday.
Yeah, it was pretty interesting actually. I wasn't expecting it to be that bad though for KC. KC did a really good job of sort of controlling the run game of the Eagles, but other than that, it was just Eagles were rolling, which was nice. We get Mahomes a little bit out of the Brady area, which made me happy.
Yeah, I think we bought us like 3 to 5 years on that conversation again, which is nice.
Yeah.
Darcy, what do you think of the Super Bowl?
You know what? I had my Patriots gear on because we're going to be there next year. So that's
Oh,
where I
wow.
am.
Love it.
Yeah. I'm a diehard.
Darcy
I wore
just
my Tom
flying.
Brady socks and everything. So, yeah.
Darcy's going to have to come on the cheap seats and give us some football takes when the season starts back up. All right. Well, listen, we have a lot of mortgage stuff to go through today. We had some news yesterday. Chris put out a prompt online, social media, asking for topics, questions that people had. So we have a whole bunch of things to run through with people. I think it'll be that kind of episode where we go through some news, go through some Q&A, looking at the questions ahead of time. There's probably some good basic things that it's worth getting out there for people that listen. So before I get to that, yesterday we had a little bit of a economic dump on inflation rates. Beds, what happened with that?
I'm looking at it in the background as the question came my way. I continue to be amazed by the hotter than expected economic data. I mean, over the last couple of months, it's been interesting where you get sort of a couple of stale ones, and then, you have one that was, which was a higher than expected one yesterday. We're filming this on Thursday. This was a Tuesday report. So mortgage-backed securities sold off. And when mortgage-backed securities sell off, interest rates have a tendency to rise. So, with that data on Tuesday, I'm taking a look at the chart. We sold off about 50 basis points, which, all of these charts that I follow, you've got some moving averages there. So we had some room to lose 50 basis points this morning. The 10-year Treasury is down 8, which is nice for us. We're up 25 basis points. So it seems like the recovery is happening already. But yeah, man, it's just another run of seesaw within economic data, a little bit, here and there where it's like, all right, interest rates are going to push lower and then we get chopped off at the knees. That's what happened Tuesday.
What were you thinking yesterday, Darcy?
Yeah, I kind of take a look at PPI a little bit more, which is coming out, tomorrow. So I think I think that's why we're seeing the bounce back today. And we also already started to see it yesterday afternoon. I think it was an overreaction, and we're going to start to see it. It's just slow. I mean, we were talking 15 months ago that we would be possibly in the high fives at this point right now. And that is just not happening. So it's a long ride.
Yeah.
We'll get there.
We've been hearing high fives for a couple of years now. It's just 3 months away. 6 months away, it'll be up in the upper fives again. It's just things keep seeming to push that back. So yesterday's reading, correct me if I'm wrong, I'm reading as we're doing this, but the median CPI reading was 3.9% annualized, up from 3.59, which is pretty hot. So that is what we were seeing the reaction to. So we'll continue to monitor. Like you said, PPI is out tomorrow. It's stuff we're always watching. We do not have a crystal ball on these things. So we're just kind of along for the ride with everyone else. At some point, rates will push down. I know that everyone wants that to happen, but for now, there's a little bit of pressure to keep them up. So any other thoughts on rates before we move on from that?
I think that's why it's so important about the rate rebound program that CMG has. So, and how the three of us are really great about connecting with our borrowers. So that's what I would say about it.
Did you want to elaborate on that rate rebound while we get you talking about it?
Sure. It's a proprietary program for us here at CMG where we can offer our borrowers, really, really heavily discounted refinance. And we can do that as rates go down for about 5 years. We can do it every 6 months. And it's just unlike something that we've never had access to with former companies. So.
Yeah, looking forward to being able to implement that. So we're waiving lender fees, appraisal fees, and significant discount on those closing costs for refis, and to save people a lot of money that are buying with these high rates in the hopes that rates go down at some point in the next 6 to 12 to 18 months. All right, cool. We'll keep it rolling. So we have a bunch of questions, and I think there's just two things that I want to mention that kind of came up in the past month for me before I get to those questions. Are you guys familiar with the Fresh program that CMG offers? Do you want to just say what that is real quick, one of you two?
Darcy, go ahead.
Okay. So and I can't even cover all of the people that it covers, but basically it's for our first responders, our heroes out there, teachers, medical nurses, doctors, all of that. And it really is for paramedics is another great one out there.
There's really like 25 different categories of people that fall under this.
What it is we've partnered with some of our title companies and offers discounts for both title companies as well as our fees. We reduce our fees as well for those that are, you don't have to be a first-time home buyer or anything. Yeah. It's just for those heroes.
Exactly. And that's been extended through June 30th, 2025. So another 4 or 5 months, which is worth mentioning to people for those that may work in those industries. So thank you for your service. And on that front, Beds, you've had some cannabis buyers recently, right? Or prospects?
Yes, I have.
So we were told that Fannie allows you to be a W-2 employee of a cannabis company, which wasn't always the case. Is that true?
Yeah, so we have federal versus state law here. A little bit of the issue with lending is if you are the owner of a cannabis company, it sort of excludes you because right now it's sort of not in the area federally to acknowledge that income. But if you are an employee of a cannabis company, we can offer any of the loans that we offer. One of the areas that was an issue in the past, or the determination is could you do a VA loan if you were an employee of a cannabis company? The answer to that is also yes. So I guess if we've got a borrower coming our way and it's the owner, it's still an issue. But if you are an employee of a cannabis company, we can offer that loan.
Yeah, and it's just worth mentioning. I mean, cannabis stuff comes up all the time. I know people are very interested in that field and concerned how it affects their ability to get a mortgage. And I just think it's just worth sharing that it doesn't mean that you can't get a loan at this point, because in the past that was the case.
And I think the sheer volume of companies out there is like, if I took a ride up to Farmington recently just to watch one of the UMF basketball games.
From like 400 weed places on the way up there.
I am not joking. We counted them from, I believe it was Auburn up, and we shot up Route 4. I think there was like 25 of them. That is not an exaggeration. They are everywhere.
Yeah.
Hey, people love their weed.
Yeah.
They do love their weed, and we can help get them a mortgage. So it's worth mentioning.
Yeah. I think it is interesting that VA will allow it, but RD will not, which is both federal programs, but a little bit different in their guidelines. So.
And I expect that to evolve over time too. It already has over the past couple of years, so we'll see where that goes. Elon Musk tweeted something out the other day, said RIP SCFPB. Did you see that? So there's a lot of changes going on in the federal government, obviously a lot of cost-cutting measures, but it sounds like CFPB is on the chopping board. And that's an organization that implemented a lot of changes in the mortgage industry in 2008. And a lot of regulation stuff, the way loan officers get paid. What would you think would happen if the CFPB goes away? And do you think there's any chance that actually happens?
I'll start. I am still very confused by that tweet and what it means. Some of the early stuff that I saw was there was an initial thought of how many people would be employed within this CFPB, and I guess that number is pretty larger than what they anticipated initially. So to your point of the cost-cutting side of it, I could see them chopping it down. Removing it, I don't know what that means. I mean, so much regulation in our industry became of the CFPB, and I thought some of it was really good. The compensation laws within our industry, I am still very judgmental of that. We lost our ability to, in certain cases, cost cut commissions to give sort of rewards to past clients, family members, stuff like that. But I guess it leveled the playing field for all consumers to get sort of the same cost of loans. So
Can I elaborate on that for a sec?
What's that?
Can I elaborate on that for a second?
Yeah, please go ahead.
I think people might be interested in how we get paid, or they might not realize how we get paid. And in the past, prior to the CFPB, you could get paid on the interest rate that you charge a borrower. So the higher the interest rate, the more us as loan officers would get paid. Also, on the other side of things, like what you're talking about, is the lower the interest rate you offer, the less you get paid. Now, it does not work that way. And people might think it still does, but we get paid on the loan amount that we do a loan for, not the interest rate that we charge the borrower. So I have no incentive to get a higher interest rate for my borrower in exchange to get paid more. Like, I want to get the best interest rate that I can for our borrowers. We get paid based off of that loan amount. But like you said, there was no ability for us to cut our commission to get a lower rate. But like, it does protect the borrowers against those people that were predatory and would jack up the interest rate, make a ton of money, and then 6 months later just be like, oh, rates came down, and then get them another refinance, kind of churn and burn through their client base. So it's probably good that they did that, but I remember that was a big change when it happened a while ago.
I guess a comparable here in the conversation is if a real estate agent wants to do a favor for somebody, and instead of charging a 3% commission, they charge a 2%. That was sort of the comparable on our end that we lost. But back to your question, I just don't know what it all means. If this goes away, does that mean regulation is lessened? Probably. What does that look like in our industry? I'm not quite sure. And how quickly that happens, I don't know. So at this point, Elon's tweeting, we're seeing it as it happens. I don't know what it means.
Yeah. Darcy, any thoughts?
Yeah, I worry about some of the other protections that have come from the CFPB. Things like real recently, medical collections, right?
Mm-hmm.
We have struggled with those medical collections for years and how severely they impact your credit score, which in turn impacts your interest rate, right? Because interest rates are driven by credit score. So with that change recently where medical collections, as long as they can't put medical collections on credit anymore. So we're going to start seeing some of that happen. So my gut is there are definitely good things with the CFPB. Maybe there are some things that can be cut, but I don't think that it can be, you don't want it going away.
Yeah, no, it's been good for the consumer, and I wouldn't expect it to disappear and all the rule changes that we've had over the past 16 years to completely be reverted. You know, it's just one of those things. He puts those tweets out there, starts a big conversation. I'm sure some things will change, but my hope is that, and the expectation is that it's just not as crazy as just removing the whole thing altogether.
Yeah.
So, all right, on to some questions. Okay, you guys ready for me to fire away?
Let's dance.
I like this first one, and I kind of reordered them beds from what you sent me earlier, but on a simple level, can you explain how someone applies for a mortgage with you? Who wants to take that one?
Darcy, bat lead off. Let's go.
Okay, great. So the easiest way is to have an initial conversation with any of us. Things start on the phone for us, at least. We like to have a conversation so that we can get to know you a little bit, get to find out what your goals are. And then the easy part is really filling out the application. We all have links directly to our pipelines where you fill out the application. You can get us the documents that we need to have a solid pre-approval and have a solid approval with you. And the rest is really kind of done online. There's a lot of working online, but definitely for the three of us, we are very vested in taking care of our clients and talking to them up front to walk them through the process. So.
Yeah, and I'll let you go in a sec, Beds, but yeah, applying online is something that I've really learned to love over the past few years. There was a time where I really liked to take down people's information verbally, and put it into the loan application software, because I always felt like I was pushing people off. Like I don't want you to feel like I'm pushing you off by directing you to this online loan application, but it's very easy. Again, it teaches you how the system works, so you can upload documents directly and ensures accuracy of the information. Sometimes if I do not have perfect handwriting, so I transpose some numbers in a social security number, I get a date wrong in employment. It's like, you do the online loan application, it gets filled out correctly as far as and then we are off and running kind of from there. So Bez, did you have any thoughts on that?
Yeah, I like where you guys went with it. I just think that as a seasoned loan officer, the vetting that we do up front through our conversation, you hop on our website. I think it's sort of, I love our My Life website. I think it's a really, really nice option for consumers to use. But I think we just do a good job of vetting our client docs, making sure that the loans that we're starting are going to be loans that we can finish. So those are my thoughts on that.
Yeah, that's good stuff. How about when someone asks you about points? How do you describe what points are? It seems like this term, people might not fully understand exactly what it means, and they know it's tied to interest rates, but how does it work?
I'll start. I always say that I try to discourage people from paying points, first of all, because of the fluctuation in interest rates. But my simple answer is it's always a percentage point of your borrowed loan amount usually equals a reduction, depending on market conditions, of an eighth to a quarter. So if your borrowed loan amount is $300,000, 1 point equals $3,000. So you can expect about an eighth to a quarter reduction interest rate, again, market conditions. But my thing and my dislike about points is that if you're only saving $50 a month and you pay $3,000, you could do the sort of turn time of how that makes sense. And I think the national average is people are in mortgages a little bit over 3 years. So it's like the turn time of paying points never makes sense for me. But I don't know. What do you guys think about it?
Yeah, that's kind of where I'm at with it. So just to be clear, paying points is paying a fee to lower your interest rate. And the idea is you make up the cost of that fee over a period of time. And then if you go beyond that period of time, it's just gravy and you're saving money. I think the math I typically do is about 3.5 years on the points paying off. And if you're in this environment where you expect rates to drop in the next 12 to 18 months, I don't know that points makes a lot of sense for me. Like, I just don't feel comfortable leading with that. I mean, I'll give people the options because they always ask me, but for me, I would probably want to keep my points to a minimum and look to refinance at some point in the future. Yeah. What do you say, Darcy?
I always call points prepaid interest. That's what it is, right? You're prepaying for interest. What I think is a really great alternative, and I've actually closed a couple of loans recently, is the idea of a 1-year buy down. We keep talking about interest rates going down over the next couple of years, or at least a year. And doing the 1-year buy down, you're not necessarily prepaying interest. What you're prepaying is your mortgage payment, so that you can get some relief until rates go down. So that's a great alternative.
Sorry to cut you off, Rudy. One case that I can say for sure where I would need points is if you're sitting on the fence of qualification, so your debt to income ratio is sort of at the max, and you need to reach another $10,000 or $15,000 to get a property. Then paying points to bring that interest rate down, to bring the DTI down, makes sense.
100%. Yeah, good point.
Do you notice that other lenders that you're competing against kind of lead with points or sneak points into transactions?
Oh man, that is such an area that I judge big time, because anybody likes to see the shiny toy, but it's like, how much do you actually have to pay for it is another thing.
The shiny toy being the low interest rate.
Exactly.
Because if you don't look at the points thing and you're comparing a rate with points to a rate with no points, just on the rate alone, it can be confusing for people.
Right. It's the why of why your interest rate is that much lower.
Yep.
So, yep.
Rocket Mortgage, for example, I've always told people that they kind of lead with 1 or 2 points. So people call me after getting a quote from Rocket Mortgage, and their closing costs are super high, but their rate is, like you said, the shiny toy. You have to explain that to them, but a lot of people just don't really understand what that is. So trying to educate people. Hopefully anyone that hears this conversation can understand a little bit better what the difference between a rate with points is and a rate with no points, and when it may make more sense. But I think it's a great question. So, great. Other question. Can you explain the third-party fees versus the escrow part of closing costs?
I like this one because if you're sitting in front of me, the hand gestures start. It's like I'm working on a teleprompter. breaking down a play on the football field. Simply two different costs go into obtaining a mortgage. You have your third-party fees, your real estate transfer tax, your title fees, your appraisal fees, and your recording fees. These are the third parties that get involved. They need to be compensated for the work that they do. The other side of the coin is if you are obtaining a mortgage and you want an escrow account for taxes and insurance, a big part of how I deal with buyer clients is okay, a determinant of those costs is what are you offering for the property? That determines some of the third-party fees. And then the other side of it is how much are the yearly taxes? We need to set up an escrow for taxes and insurance so that when you leave us after the closing, there's enough money in your mortgage to pay those two items. So my communication typically is how much is the property, how much are the yearly taxes, and it takes me like 33 seconds to figure this out. So yeah, so that's how I do it.
Yeah. And I would add to that, mortgage payments are paid in arrears. So you're paying for the month behind you, and that escrow account is based on your first payment date. So if you're closing March 15th and your first payment date isn't until May 1st, but those taxes are going to come up in July or August, whatever it's going to come up, you have to set up that escrow account accordingly. So,
and I do think the escrow part of the loan estimate that we give to borrowers, estimating these things up front, is a room for like a miscommunication on comparison between lenders, because I could try to undercut and say, hey, you're only going to need 3 months worth of escrow, and another lender's going to say 6 months, or vice versa. Just know that it's basically going to be the same when it all shakes out at the end from one lender to another. And I kind of tell people that I think the main thing that separates any lender or bank when it comes to closing costs really is that bank or lender's fees, origination fees, processing fees. I mean, those third-party fees that you talk about, Beds, are going to be the same generally, within a pretty small margin from one bank or lender to another. And the escrows are all based on the taxes and when the next tax bill is due and the insurance that you get and all these things. So those things should all be pretty similar from one lender to another.
I think simply the higher the purchase price and the higher the taxes, don't be shocked that the closing costs are higher. And it's those two simple factors that make them that high. Yeah.
When people used to ask me years ago, what's my estimate for closing costs, not knowing anything other than the purchase price, the numbers that come to mind now versus then are just, it's crazy. I used to never tell people $10,000 for closing costs, $11,000, $12,000. It's very common for closing costs between our fees, third-party fees, and escrows to get to that number, especially with purchase prices in the $400,000, $500,000, $600,000, $700,000 price range.
I think a thing to discuss is how do you peel back some of that figure? Well, you don't get an escrow account if you have 20% down. Mm-hmm. There's also the option, which I don't advise, where you don't have to purchase title insurance as an owner. And then if you pay the insurance on the property outside of the closing, then we don't need to collect it for them. So there's a couple of ways to lower that number. Mostly I wouldn't advise them, though.
Yeah. Well, you should mention, too, that if you're going to not escrow for taxes and insurance, there's an added cost or a fee that you have to pay as a borrower. Lenders really want to incentivize borrowers to build taxes and insurance into their payment just to ensure that those things are actually paid or increase the likelihood that they're paid. So, yes, you can do those things, but you're doing it at the exchange of a fee. It's a 0.25% fee to not escrow for taxes and insurance on a $400,000 loan. It's $1,000. At that point, it's like, just escrow, in my opinion.
And a little secret that people may not want us to share, or CMG may not want us to share, is you can often, if you do have that 20% down, you can often, after the fact, go back and say, hey, I don't want to escrow anymore. So it's always worth a shot.
I'm going to edit that part out of the podcast.
Okay.
Just kidding. I'm not. That is good to know. All right.
Okay, Elon.
I'm going to have AI kind of alter some of this, like redo the whole video. All right. We had Uncle Tony on to talk a little bit about this, but Beds, how does the U.S. Treasury affect mortgage rates?
Okay. The best way to describe the U.S. Treasury is that it's a safe haven. It's a safe investment. It pays a low rate of return, but when there's, I guess when the market is a little uneasy, a lot of the higher paying areas of where to put your money, the stock market specifically, a lot of money flows out of the stock market and will head to the bond market. When money is flowing into the bond market, that's a good thing for mortgage-backed securities. The simple logic also is like good news, bad news, excuse me, is good news for us. So when there's economic data that sort of suggests pulling your money out of riskier investments, it goes into bonds, back mortgage-backed securities, and that makes our interest rates lower. As I ramble about that, I wonder how the great Uncle Tony would have explained it, but that's how I do it.
The thing that Uncle Tony mentioned that was something I knew inherently, but just it was funny to hear just that you can just kind of do the math on inflation and then to Treasury bonds, and then add 2% to that, and that's what mortgage rates should be. So I think the 10-year Treasury is somewhere in the mid-4s, so rates are somewhere in the upper 6s, around 7. So, when you see that 10-year Treasury go down, know that that's good for interest rates. Weren't we in like the 2s a couple years ago?
Yes, we were.
Yes, we were.
Those days were not glorious.
What? Glorious?
That was glorious.
It was glorious, but we are facing some of the repercussions for that right now in this market. So it was a good run, though. It was a good one. Darce, how does mortgage recasting work?
So mortgage recasting is a way to pay down on the principal. So as long as you make a $10,000 payment down on your principal, we will actually change your payment based on the new loan amount.
Yeah.
So it does cost a little bit of money. I think it's maybe $250 or so, $300, somewhere
Something
right
like
around
that.
there,
$200.
to be able to recast it. But what happens is, say you purchase your house right now and you had to go without a home sale contingency, and your loan amount is $700,000, but yet you're going to sell your house and you're going to make $200,000 to put that down. Your new loan amount is going to be $500,000. And if you do that 3 months after you close, you can recast that payment, and you're going to recast it based on the current term. So if you do it in 3 months, we're going to recast it for 29 years and 7 months. It's different from refinancing. We're not changing your interest rate. We're not changing your note. We're not changing anything about it. We're just changing your payment.
Yeah. Which, again, the use case you mentioned is what I would typically see too. The people that are carrying 2 mortgages for a period of time, and they're waiting for proceeds from the sale of one home to pay down that mortgage on the new one. So I got one that's going to be doing that soon too. So super easy. People ask about it all the time. Please know that it's a thing.
Or if you have some money and you think you're going to do an addition on the house, something like that. It's always easier to save money now than to try to take it out later on. Mm-hmm. Although I love me a good cash out refinance, don't get me wrong, but it's for you, it's a little bit cheaper, right? Yeah. So, if you decide not to do that, then you can certainly recast the loan.
Yeah. So good stuff. Bets. What do you got?
Yeah, my quick thoughts on that. Darcy just dominated that. Let's move on.
Chris, here's an easy one for you. What's the most common loan type, and why do you feel it's the most common?
It's just a vanilla conventional mortgage. As a loan officer, it's easy to identify credit scores if they fit within the criteria of a conventional mortgage. Does the borrower have the credit history within that credit report? And, you have your standard 5% down mortgage and all the way up to 20 or 25 plus more percent. Fannie Mae, Freddie Mac. Those are the riding the bike type of loans that we've been offering forever. And at this point in my career, and you guys could probably attest to this, you see the borrower's credit profile, it just sticks in a conforming loan. But to me, that's the most common one.
Since COVID, it's kind of been the type of loan that we've had to do for most people. I would bet you, if I look at the numbers for the past 5 years, I'm probably north of 95% of my loans being conventional loans. And the reason is because it's almost like the sellers and listing agents have dictated that buyers need to use conventional financing for their offer to be accepted. There's a perception that conventional buyers are more qualified. There's less likely to be problems. The appraisals are easier. So for that reason, we've had to basically try to fit everyone into a conventional box if we can. And if we can't, there are other loan types. But it's definitely led to the conventional loan being the most common thing. And probably will be in the seller's market for a while. Darce, what about you? Obviously conventional.
Yeah, conventional, I guess some of it depends on where you're located too. I fortunately happen to be close to the shipyard in Portsmouth and can do quite a few VA loans, and they can be advantageous, especially if you have some disability, and VA is pretty liberal with their VA disability because you
They
get
are.
to waive that funding fee. And the rates are better. There's no doubt about it.
Mhm.
So I find that it's really important just to educate our realtors
Mhm.
and referral partners on the benefits. And VA has changed their guidelines over the years, especially in terms of appraisal. There's
Yep.
still a little bit of a stigma out of there, but that changed back in 2019. So I
Yep.
think that's
Well, someone asked about VA loans as well. So the big benefit to that VA loans is the no money down and no PMI. So for borrowers that have less than 20 that are veterans, then I think it's a no-brainer. And there is a use case for it beyond that too. Like you said, if you have your funding fee waived, normally there's a percentage that a veteran has to pay built into the loan. Be a little bit more than 2% for the first use. On a $400,000, 2% is $8,000. And again, it's a great loan for a number of reasons, better rate and no PMI and all that stuff. But if you have a bigger down payment, it might not make sense because of that funding fee. But if you can get it waived because you're disabled, at least by recognized by the VA, and get that waived, and it's a great loan. So definitely wouldn't sleep on the VA loan. Ed, do you want to touch on FHA, RD loans real quick? I know some people ask for the differences on those things. When would we use those sort of things?
Yeah, let's talk no money down. So we just talked about VA. That's a nice option. So if you're not a veteran, you could use the Rural Development Loan. You hear a lot of that particular loan product by its acronym RD. So it's for single family housing. There's a map that we use. We go in there and we just plug in an address to make sure it's deemed rural. As long as it's a single family home, we could offer a borrower no money down. What's a little different compared to VA? So RD does have a funding fee, so there's not a case to waive it. There is a minor amount of monthly mortgage insurance, but they call it a monthly funding fee. So that's a nice option. So VA, best case scenario, RD, no money down, couple of different variances against VA. So the FHA bracket, why would somebody go into a FHA loan? Lower credit score borrowers, lower down payment scenario. I like the monthly mortgage insurance amount, so it's not obnoxious, but that option is 3.5% down. Really nice sort of purchase option with FHA is buying a multifamily owner occupied. So those are some of the quick thought processes I have between the three of them. What do you guys think?
I would just add the only thing is on FHA, high debt to income ratio. You definitely have an advantage if you have some extra money that you make on a side gig or something, but we can't use it to help you qualify. You can really kind of go a little bit higher on those debt to income ratios. So FHA might be your key. And conversely, RD might be a problem because RD limits what your housing ratio can be.
Yeah,
I know
it's a little more restrictive
there, but yeah. So.
Yeah, this conversation is kind of showing what we have to go through with every borrower that we work with, where we're looking at their situation, looking at their credit score, down payment, what they want to achieve, where they want to buy, all those sort of things, and just figuring out what program makes the most sense. Unfortunately, over the past few years, getting back to the conventional, I haven't always thought conventional is what made the most sense for the buyers I've worked with, but very upfront with them. I mean, this is almost what we have to do in this market where there's going to be 10 offers and your FHA offer is going to be put to the bottom of the pile if we don't come in conventionally. But we're always adapting to the market and going over these different things with our buyers, so it's a good conversation to have.
One quick thing that I want to add is I have a transaction closing this month, and this is an example where FHA is a really nice option. They have a mid FICO score of 608, so you're sitting below in an area that most mortgage products will not let you in. So FICO score is an advantage here with FHA. You've got an option, number one. Number two, your front end ratio max has a tendency to be around 40. Is it 47, guys?
Yeah.
With the back end of 47,
back end
but
56.
Yeah, 55.9.
Yeah, so in this case with this borrower, I have a lower FICO score. I do have a decent down payment, but to fit it all in, you have two of the hardest variables to get through that FHA is like, yeah, no big deal, we'll take. The front end ratio on my loan is a 45 and the credit score is below 620. So don't sleep on FHA. FHA is awesome.
Yeah, when you say front ratio, just so people understand, that's the percentage the mortgage payment is of someone's income. So the mortgage payment alone is 45% of what their income is, and FHA will allow you to go that high. So like you said, don't sleep on it. Rehab loans. Do you guys have rehab loan conversations a lot?
Just had one yesterday.
What's
Yeah.
like the short version of how you explain that to people? Because there are a ton of moving parts, but there is an initial like basically script that I go through when people ask me how it works. What do you usually say, Darcy?
I think the greatest thing about a rehab loan is that we use the after improved value of the property on the appraisal. So, you take whatever the value is right now, and the house is going to be appraised based on what you're adding to it. Are you upgrading the bathroom? Are you adding square footage? Are you adding an extra bedroom? The appraiser is actually going to not consider what your value is right now. They're going to consider what the value is after it's done. And that's how we determine how much money you have to put into the transaction, that type of thing.
But it's important to say how we get there, though, because you have to establish what work's going to be done. I always tell people you have to work with a HUD consultant. Typically, this is basically a glorified home inspector that's going to meet you at the property. They're going to look at the things that need to be done to meet minimum health and safety standards. They're going to look at the things that you want to have done just out of personal preference. They're going to put together a write-up for you. You're going to take that to a builder, right? You're not going to do any of this work yourself. I mean, there's little workarounds that might be better for a conversation down the road. But like in general, you have to work with a builder or contractor who's going to quote out all those things. And that quote with labor and materials is what you're going to give to the appraiser so they know what you're going to be doing to the home so they can take into account that aftermarket value. So it's a great loan, but that condensed version of HUD consultant to contractor and then contractor to appraiser typically takes 2 to 4 weeks just because consultants are busy, builders aren't great with getting quotes in time, all that stuff. So just know that rehab loans take a little bit longer than regular loans, but they're great for that distressed property or even a property that you already own that you want to finance the renovations or repairs that you're doing. So good loan. Talk about it a lot.
Yeah, so if you're a real estate agent, you're looking at a property with a buyer that's approved for this process, it's standard. You just put something under contract. Immediately we need to line you up, or if you have one already with a contractor, we'll get the consultant involved. So it's real estate agent, buyer, the consultant contractor initially going to the property. There's a scope of work that's determined based off of that loan product, which creates the quote from the contractor, which gives us a number that we know that we need to originate the mortgage on. So under contract, get all those parties together, a number's produced, loan officers working on it, we get it to a closing. So that closing is a standard, just like you're used to. You get paid for handling the transaction, but on our end, that's when a lot of the work sort of begins with the administrative stuff, where there's a draw, there's milestones of work behind the scenes, there's sort of between photos, the HUD consultant, and sort of the administrative part of it, there's milestones of work done, which creates the draws. And, at the end, it sort of wraps up and then the property's all completed.
It's a great loan. I think it's less competitive in purchase scenarios unless the home is a complete mess and there's not a lot of competition for it. But definitely can be used in those situations. I've done it. It's great for refi scenarios where you're already on the property and you want to finance the cost of renovations, repairs. You might not have the equity, but you would when you factor in the work that you're actually doing. So it can be done on a purchase or refinance basis. All right, last question, or at least the last one I'm going to ask. How does it work for people going through divorce looking to refinance?
So I built a little bit of a niche for this, so I'm going to take this. I
Yes.
actually have 2 divorce transactions in right now. And attorneys won't want me to say this, but I'm going to say it anyway. If I can get into the transaction before it gets to an attorney, I can help both sides understand what the ramifications are about whether you're even going to qualify. You could have someone, that's the biggest key, right? Can I even qualify? What am I using for an appraised value? What is equal? Is it 50-50 on the equity? Is it a certain amount that might be different because of child support or alimony or whatever the case might be? But you could have someone that doesn't even qualify, and you want to get in before maybe something goes sour with a divorce and somebody starts making a late payment, and then you're screwed, right? So But divorce situations are handled very privately. We are all super professional about this, and we're here to help and get you through a difficult time, for sure.
What's huge about it too on the guidelines side of things is it breaks down to two separate things: a separation agreement that's recorded or a divorce decree. So we need to know what obligations are while people are going through this. So if you want to do a transaction prior to a divorce, you need to have a separation agreement recorded, because that's going to tell our underwriter who's responsible for what, which ultimately means we could calculate a final debt to income ratio. I love Darcy's thought process, because you can come in as a consultant, as a loan officer, to kind of get people to play nice, right, Darcy?
Absolutely.
So which ultimately would help with a separation agreement prior to a divorce if both parties are just cool. You know, you want to get out there and, you know, the remaining person that can afford something, if you want to buy something prior to that set divorce timeline, we're going to help you with a separation agreement, but you got to get it recorded. That's the major thing that I'm always talking about with people that are going through divorce. And you guys know this. I can get 17 different variances of a question. Can I do this? Can I do that? It just simply breaks down to a divorce decree or a separation agreement.
And I just want to talk about why this is important, because it's important to know that when two parties have a mortgage together, you can't just peel someone off of the note. The only way to do that is to get a new one in just one of those parties' names, replacing the one that both people are on. So that's why it's important to address this when going through divorce. And it's just, you can't just sign a divorce decree and then the lender agrees to remove one party from the note. It doesn't work that way, because when they did the note initially, they were basing it on both people's income and both people's ability to repay. So that loan was very much given to both of those people. So a lender is not going to be in a position to just say, oh yeah, sure, one of you is no longer responsible for this note that we very much gave the loan to you from the beginning. So it's important to get a new one that replaces the existing one with two people and just one party's name, if it's even possible, which I do realize those are hard situations. A lot of times when you're removing one person's income from the situation, it is challenging, and you have to be creative and you have to jump through hoops and find ways to make it happen. But I think we're all equipped to do that.
One more thing that I want to jump in on is that when you do have a divorce or separation agreement and there's a party that ends up with that mortgage, to sort of piggyback Randy's thought, is you need to make sure, if you're the other spouse that's no longer in that home, that that person is actually paying the mortgage. Even though your divorce decree says, you know, the other person that's staying in the property is responsible for it, if they let that mortgage go and they start not paying it, that divorce decree doesn't mean anything on the credit agency side or that lender's side. They're going to start hitting you with 30, 60, and 90-day lates, and all of a sudden you went from a 780 mid FICO score to a 520, and you're not going to be able to buy anything. So the major thing here is if you're advising anybody going through this, end of the day, that mortgage needs to be paid.
Yep.
Yeah.
So.
And there's different guidelines for how long that mortgage might have gone late. So I have one right now. They can't refinance because it went to 120-day late, which was pre-foreclosure. And
Yeah.
even with the easiest of loans, FHA, that is a problem.
Yeah. Yep. So yeah, have those conversations with us early before it gets to that point. Would be a good takeaway from this. We can definitely help. So I think that that's a good way to end it. 45 minutes of just nonstop mortgage action and knowledge. Thought we touched on a lot of good things. I appreciate everyone that asked questions. It gave us a lot of good information to discuss. So before we wind down and wrap it up, do you guys have anything else you want to share, market-wise, events coming up, anything at all?
No, I just want to say thank you for having me. I love this, and I'm glad to help you guys out. So.
Darcy, we love you. Thanks for coming on. Darcy is down in York, so she's like our mortgage sister and part of the CMG family. So glad to have you come on.
Great. Thanks.
I'm going to piggyback Randy. Darcy, you are our queen. You've always been really good to us. I appreciate it. And I hope everybody listening today enjoyed having Darcy, because we love the Darcy.
Yep. So, all right, guys, we'll talk again soon. Everyone, thanks for listening. Appreciate the support.
See ya.
See ya.
Thanks, guys.